Yeah, well, it's pretty different. I think when we were doing early stage investment, our thesis was, well, we know that only a small percentage of companies will be successful at large scale. And so we were going to make a large number of investments per fund. We would look for some amount of success. And so that might be that they've been able to build a product, that they've gotten a certain number of users or customers, they're generating some amount of revenue and hopefully, in the future profits, but probably not much profit at the time. Even many companies, they might not already be at revenue, but we were looking for at least two or three areas of success that they'd been able to figure out. So you're not looking for perfection. You're looking for ability to survive and iterate and make progress. And so we would look at maybe, I would say, 5 or 6 different categories: product, market, revenue, growth, team. And if, it looked like it was interesting on at least 2 or 3 of those 5 or 6 factors, we would say, okay, great. It looks like you're making some progress. Let's write a small check and see how it goes. And we knew that, most of those companies probably wouldn't make it, but maybe a third to a half would make it to the next stage, and maybe half of those would get to the next stage. And so we were sort of thinking in our heads that maybe 5 to 10% of these companies could get to some interesting level of, potential outcome where that might be 10x or better on our returns. If we looked at what we're doing now, it's much more later stage investment. We buy secondary positions either in funds or companies. And I would say more, we do that at the fund level. And I can explain a little bit why. But if we're looking at companies, we're typically looking companies that are already at Series B or C stages of investment, probably 50 to 100 million in revenue. And part of our, thesis here is we'd like to see an exit in the next 3 to 5 years. And so if we think about in the US IPO market today, probably $300 or $400 million worth of revenue is typically what we would expect to see at a minimum for companies that are going public. We probably want to see that they're already getting close to 100 million in revenue to have a shot, within a few years of growth. And so that's a very different profile of company. Most of those companies are already, at some size or scale, maybe a couple hundred people. They probably have, established line of business. They probably have hopefully some profits or at least some positive unit economics. And they have a amount of growth that, we'd hope to see at 50 to 100% or more per year, and that has an ability to sustain itself. So, we're not looking at potential wins. We're looking at things that are already successful and growing. We still know we'll have some percentage that don't continue to grow or don't get to an exit. But hopefully in this case, it's more like, 50% of them will get to an exit, maybe more than 50%, and hopefully at least a third to half of them will get to an IPO. And again, within a 3 to 5 year period. If we're buying fund positions, then we're looking at funds that are at least 5 years old, maybe even 7 to 10 years old. Probably those funds have one or more winners that we think are headed to an IPO. And kind of what we know from experience is that some number of the investors don't want to have to wait, 12 to 15 years to see exits. They may not have realized how long it was going to take when they first invested in those funds. But what we've seen is, at least for the non-institutional investors, for the earlier stage, smaller funds, there's usually some number of investors who are looking for an exit early in that 5 to 10 year period. And particularly right now in the current market, that's certainly the case where there hasn't been very many exits for the last 2 or 3 years. And a lot of people are looking for liquidity. So, now we're looking not so much as potential, but like sort of already established businesses, established, profits and growth. And we have a pretty, tight filter where we want to see exits within a, 3 to 5 year period of time. So it's quite different than what we used to do. But a lot of the intuition that we have now is from watching those portfolios over the last 10 to 15 years and seeing thousands of companies. I guess I should say thousands of companies, but most of them not making it, and maybe 50 of those, 1,000 to 2,000 companies that did make it to an IPO.
How does intuition play a role today's decision and also earlier ones?
I don't think today's decisions are much based on intuition. Today's decisions are based on numbers, metrics. I guess, well, in some cases where we don't have perfect access to information, we have to make some informed decisions. We still expect to see a good bit of data, but we probably look at a portfolio size now that's only 20 to 30 investments, whether those are companies or funds. Whereas before we used to look at 200 to 300. So, we're coming in much later in a stage of company, probably 5 to 7 years later than we would normally. And we're also cutting the portfolio size down by, an order of magnitude, really, from, a couple hundred to maybe just 20 or 30. So it is different in that we don't really rely on intuition. And even when we were doing 500, it wasn't like we were relying on intuition, but there was less data to look at. Here, there's a lot of data to look at.